Hi, my name is Bob Gersh with East Coast Capital. And if you or your spouse is 62 plus, we have a fantastic program which may be useful in being able to reduce your mortgage payments. What you need to do is go to our website, which is connected to this video, which is seniormortgages.now.site. So seniormortgages.now.site. And look at the links. You'll see a link to a website, askbobgersh.com. You'll see my email address, and you'll see my phone number and some other appropriate links. The first thing you would need to do to see if you may qualify to be able to reduce your mortgage payments is to be able to go to the askbobgersh.com website, click on calculation, and if you're 62 plus, you could just indicate that you're looking to refinance, the dates of your birth for yourself and your spouse, and the estimate value for your house. Clicking on that, you'll find an indicator which will tell you how much you could get if you could qualify and have enough equity to be able to come to the table and do a refinancing of your mortgage. All that would be self-explanatory on that calculator. Once you've done that and determined that your numbers work, and I'm going to be real simplistic in my numbers now. As an example, if your house has a value of $300,000 and you're 62 plus, you or your wife, so $300,000, you would get approximately $145,000. That's just a round estimate. So a little less than half of the value. Now you put in the amount of your existing mortgage, and it'll then tell you, so if the existing mortgage is $100,000, you would have an extra $45,000 line of credit. If your amount of your value of your house was $300,000, and you had a mortgage of, let's say, $200,000, then you'd have to bring money to closing. So at least you would know and have a good estimate if, in this case, with the 300, and let's say that it was a $100,000 mortgage, and therefore you'd have a line of credit of $45,000, then you know the numbers work. So you wouldn't be going through the process without some kind of estimate right up front of the numbers. Once you do that, go back to the seniormortgages.now.site website and look at my email address. Send me a copy of your latest mortgage statement, your monthly mortgage statement. If you're having it automatically taken out of your account, you should still get a monthly statement. If not, give a call to the servicer and ask them to send you a copy of that statement, and then email a copy to me. With that information, we can run some additional calculations and be more specific on your particular situation as to, after paying off your existing mortgage, what would be that additional line, if anything. Or in certain cases, it'll say you need to bring so much to closing, and you'll know if you bring that to closing, you'll again be able to refinance into a home equity conversion mortgage insured by the FHA, which would not require any monthly payments. You're still going to notice like a regular mortgage, but you could choose to make a payment or not, make it when you want, and or make it when you're ready to sell your house. So that would be the steps, and that would reduce your mortgage. Now, in a lot of cases, if you still have a significant balance that is owed, and if you do have the cash flows, you may want to choose to do this program because you can, when you get your monthly statements each month, send a copy of that statement in with a check and be able to reduce the principal of your existing mortgage. But because there's no required payment, you could do it anytime you choose and skip a month of cash flow, and that month was different than the other months without any penalties because there's no expected payment. So that way you could be able to, over a period of time, reduce your mortgage if you have other cash flow, but with the flexibility and the protection. And there's two protections that I like to just mention. One is the protection that if you don't have the cash flow that month, skip a month, skip a payment, skip 2 months, whatever is most comfortable for you financially, you can do. The second part of the protection, since it's an FHA insured mortgage, one of the provisions of that mortgage is that if property values were to go down, so let's say you're at the point in time you're ready to sell the house, it's too big, you want to move into an assisted living facility or closer to your kids or further away from your kids or whatever you'd like. Let's say you're ready to make that sale. And the house that was $300,000 and you owed $100,000 now is only worth $50,000. The world has collapsed. So whatever the numbers are, if it's if you owe 250 and the house was worth 3 and now it's worth 2, and so you're 50,000 underwater, whatever it is, the calculation is that your kids can acquire that property from the estate for 95% of its market value. So that if you're in a position where you need to sell the property, but you say it's underwater, well, the FHA would forgive a portion of that loan so that you never are purchasing the property for anything greater, your estate or your kids, and never purchasing it greater than 95% of the then market value. So an appraisal is done and they determine the value, and then 95% of that number is what you purchase it. So the difference between what the loan is and the amount of the purchase price is forgiven to you, and you don't have to worry about that. FHA insurance covers that. So there are provisions that if you stay in your house and ultimately you pass away, your house is at that point determine what to do. If the house is worth more than the loan, your estate can put the house on the market to sell the house. But if you're underwater, you do not have to cover that payment. Your kids can be able to purchase that house again at 95% of the value based on a FHA appraisal. So there is that protection that covers you for any, so that you never are paying for more than the value of the house. So when you're factoring in how much you've drawn, pay off the existing mortgage, interest that's accrued, etc., over a period of years, and if that balance is again greater than the value of the house, your estate, your kids paying 95% of that of the new current value, and the difference is forgiven. So that if your kids want to keep the family house, they can, and don't have to pay off the larger loan amount. So that's a great provision in the circumstances where you have a house that the kids want to have. Whereas if you didn't have this kind of mortgage and you had a traditional mortgage, you would have to pay off, the kids would have to pay off the balance of that loan. You can't get that waiver of that difference between 95% of the current market value and the loan amount. So there's some good value in having this kind of loan for situation. Here, a lot of times people say, no, I don't want to borrow. I just want to pay my loan the way it is until it's paid off. But what if something happens to you in the meantime and you're in a situation where values have considerably gone down? How are you going to be able to handle that? This kind of loan, you do pay your real estate taxes like any other mortgage. You would pay your real estate taxes. You would pay your homeowner's insurance, your HOA, your utilities, etc. But as far as the principal and interest on a mortgage, we're basically not requiring a payment on this kind of loan. So it's something to think about. And again, you can go to askbobgersh.com and click on calculator and calculate out how your numbers would look. And if they look fine from your perspective, at least you know that part is done. Then you go back to my email address, send me a copy of your current mortgage statement and your contact information and what the best way to contact you, either by phone or through a Zoom session. And we can then coordinate that and then talk at that point about the rest of the program, what documents would be required for you to collect. And basically, we're looking for income documents, your list of your assets, basically investment accounts, IRAs, retirement accounts, copy of information regarding Social Security, other pension type payments on that. We would collect all of that and basically run the credit report with your permission. And at that point, it's not credit driven, but we do look at the items that are on the report to determine if there's anything that needs to be resolved before we give you this kind of loan. And that's the basics. And what would happen is that you could, if you choose to, continue to make payments, and same as a regular mortgage, but you could skip a payment or two or whatever you'd like, whenever you'd like, and maybe never make a payment until you are ready to sell the house, or you pass away and the estate sells the house. But this way you have lots of flexibility, lots of choices, and protection again with the fact you don't have to make a monthly payment, or protection if the market were to collapse, that the difference would be your kids could still acquire that property, but now at a lower price, 95% of the fair market value, and be able to not have to make those extra mortgage payments between what you currently owe and what the house is worth. So there are some nice provisions there to talk about. This is not for everybody. Among others, you must be 62 plus, at least yourself or your spouse. You also need to, again, provide a certain documentation, but to know that the numbers work and what the steps would be, and then we could proceed to be able to complete transaction and be able to save you some money. Now, some people will just make a monthly payment, like they are doing now. And then sometime later in their life, if things change and you feel that you can't or do not desire to make a payment, you just don't have to. So those are, I think, great provisions. So this kind of loan works in many different ways for you. If you happen to have a significant amount of assets and are living off those assets, there is, depending on how your numbers come out, a line of credit available to you. And two things can happen with that line of credit. One, if you just leave it, it will continue to grow at a growth factor, which right now is roughly around 5%. Better than you can get in most investments these days, I think, or at least it's a pretty conservative, considering it's FHA insured and guaranteed. And that part of the line of credit you don't use, you'll be able to continue to grow each month. And over a period of years, even if the property values go up or down, you'll still get that growth and you can draw in those funds. So that's a great additional benefit for this kind of program, is to have that growth of that line of credit. You also can use that line of credit along with your investment portfolio. So when the market, as it has recently, gone down significantly, probably not the best time in most cases to draw on investments at a depressed price, at least compared to what it had been. But rather, this may be the appropriate time period when markets have taken a reduction in value in general, to be able to use the line of credit, drawing the line of credit, which is a way to get tax-free funds in lieu of selling investments at depressed prices. And then at such points in time as the market were to shift the other way, you have the option of paying back down that line of credit but using dollars from investments which have appreciated rather than depreciated. So there are investment strategies and tactics that can be used. We work with your investment advisors to be able to maximize the long-term value of your retirement funds, let them last longer using this method. Also, if there has been a significant reduction in your investment portfolio, but you have that equity in your home, you can be able to draw on the equity along with your investments so that your total assets will last a lot longer. So those are some of the things you could do, but those are the kind of things we can talk about on the phone and during a video chat, and would like to do that at your convenience. Just let us know when it's convenient. And as I say, if you can, go to the calculator at askbobgersh.com, do the calculations so you know where you stand before we even speak. If you're not sure what the calculations mean or how to do it, some of us are better on the computer than others. Feel free just to come to the chat room at your convenience with a copy of your current statement, and we can do those calculations together. So again, I think this is a great tool, not for everybody. That's why, we look at everyone's situation uniquely. But in a lot of cases, again, if you're 62 plus, writing that check out for a mortgage payment each month and a little concerned about either the rates are higher than you think they should be, or you have plenty of equity in the property, but cash flow is really tight, and we'd like to look at this as an option. We'd love to do that. And again, I want to mention that I hope everyone is safe, feeling well, and hope everyone's family is okay. And feel free to call me or email me, Bob Gersh at East Coast Capital, at your convenience. And the first step is look for that website, seniormortgages.now.site, which will be somewhere on the screen near the video. Thank you, and look forward to hearing from you. And if I can be of any service at any time, just give me a call. And again, thank you and have a great day.